Some of our clients do, they get tired of a house. They want to buy a bigger house. They want a better suburb sometimes. Maybe it's about school zones. And we had a case study recently which I thought would be interesting to do a deep dive in to kind of get an understanding for you as well in terms of what type of solutions what's possible right out there. So for this particular client, what they needed was the ability to buy the new home before they've sold their old home. And one of the things that we're lucky in this case that this kind of funding was available because of the client profile was bridging finance. So bridging finance, obviously it's the timing. It gives you the ability to have two mortgages effectively short term. The upside is that you know you've got your dream home before you let go of the old family home. And the downside is obviously you have two mortgage repayments, but also there's another risk in that if the market turns for the worse, then your sale price ends up becoming worse than the one than what you had envisaged. Some of the ways we mitigate that I'm going to get into as well. But for this client, there were some other things that were important. The timing was one. They needed to be able to attend auctions as well quickly without having to do a valuation on properties that they were looking for. They needed some flexibility, so they needed to be able to pay off more of the home loan if they did sell for a better price, but they needed to be able to also have the ability to pay down the debt faster. But at the same time, they wanted some security as well, knowing that if interest rates were to move up, that they didn't have the whole thing exposed to that. So the solution we came up with, first of all, was it kind of looked like this. Effectively, the bridging portion, the way we mitigated some of that is that we actually factored in a higher purchase price and a lower sale price, right? So we were a little bit more pessimistic on the numbers just in case they couldn't sell for as much, that there was a bit more buffer. So the bridging finance we actually got was really, that bridging portion had factored that in. So there was a bit of safety margin. So for that reason, we also inbuilt an offset home loan. So if they did sell for a much better price than they were expecting, or that we had pessimistically expected, that they would have a place to park those extra funds, reduce their interest cost, but still have the ability to to use those if they needed to in emergencies in the future. We took a portion of their home loan as well and fixed it for short term and a portion for the long term. Now for these clients, the short term was more important. They didn't want to be locked in long term. They wanted mobility and flexibility. They had quite good cash flow, so the ability to knock down the debt was there, and for that we needed more on the short term to be able to help them plan. And to basically tweak their plan to their changing incomes. There was a portion we did fix long term just to give them some certainty that if there were movements in the interest rates and the movements were up, that they have the impact was softened, the blow was softened somewhat. So this was the kind of solution we came up with. And look, I think the key thing is to kind of talk through your options with a financial advisor like ourselves, a good one. This is very general advice, obviously. But it worked out. They were able to go out there, bid at an auction, pick up the property. We dealt with a bank that didn't require a valuation for that auction, even though the property was, some would consider a luxury property because of the high price that they paid for it. This solution also delivered in terms of being able to obtain bridging finance, because bridging finance is not always available, right? And of course, having the ability to have some offset home loans just suited them better because they kept various accounts, which is not always suitable for a revolving credit. They did some contracting work, so they did want to put some money in a separate suffix for taxes and things, but they still want the benefit of being able to reduce their interest costs while they wait to pay those bills, right? So that's fairly important, and an offset home loan allows you to do that by running multiple accounts, 10 accounts if you want, and still offset one home loan off the back of that. But anyway, for more detailed, tailor-made solutions, feel free to contact a good financial advisor like ourselves, Hamish from monline.co.nz.